Hi, here today with Daniel Farias, Realtor and fellow James Madison University alumni.
Yes, sir. Yes.
With
Go Dukes.
Margenau Associates, and we are talking about what Daniel is seeing in this market from his customers. And what are they telling you on a day-to-day basis right now?
Yeah, of course. So one of the biggest things we're seeing now is inventory's low. That means two things. Number one, prices are going to be higher because of that. Simple supply and demand. Number two, because of the low inventory, there's less options for people to look for. So we still have a strong buyer base. Interest rates are higher, which has turned some people around. But the biggest impact of the higher interest rates is it's keeping a lot of people from selling because they don't want to leave their 3% interest rate. And so the number one thing I think we're seeing now is most people are willing to buy something, but they're waiting for the perfect property. They're waiting for the right property to come up, no issues, no problems, and they're willing to eat the higher percentage rates of interest right now. So that's probably the biggest thing that I'm seeing.
And how many showings, how many properties are you looking at with your buyers before you write?
That's a good question. Well, some people will go one weekend. We'll look at 4. We love it. Others, we'll go weeks at a time, sometimes even months, sometimes even get right up into the date of getting that final signature and then something happens and it falls through. So that's nothing new to this market, but I would say the number of buyers is certainly less than it was prior.
Sure. And you work with a lot of younger first-time home buyers.
Of course.
What are some of the misconceptions and frequently asked questions from your younger home buyers as it pertains to applying for a mortgage on a home loan?
Of course. I mean, most of those questions would be better for you to answer, frankly, because a lot of it is, do I have to put 20% down? Does it have to be 30 years? You know, a lot of that is a lot of those questions involving that process of actually being able to afford the house. It's one thing to find a house that you like. Being able to afford it is different. So what are some things that you have conversations about?
Right off the bat, the very first misconception as far as buying your first home or buying any property is, do I need to put 20% down when I'm purchasing a home? No. We've got programs for 0% down, for 3% down. We can cater loans to your specific needs and your specific financial profile. It depends upon your financial profile, your credit history, your income history, but we can tailor a loan to suit your needs.
Now, how much income history do people need to bring to you to be approved for, say, a loan or these grants or any of the programs that you have?
Well, traditionally, you're looking at 2 years of income history, tax returns, etc. However, we do have special programs where somebody, he might have just started a new job and they only have 1 year's tax return. We can work with that person. We can work with somebody who started a new job 3 months ago and does not have a tax return. We've got programs through special brokered relationships with banks that we work with other mortgage lenders that we partner with, where you'd be amazed at the types of things that you can do and the types of loans that you can use that are not crazy high interest rate, pay 3 points, etc. But real programs that can get you into a property despite maybe not having the most traditional credit profile and the most traditional financial profile.
Awesome. And so what are some things that you tell people that, say, for example, want to wait for interest rates to go down? What's a conversation like that look like?
So everybody wants to time the market, right? And nobody wants to give up their home that they're sitting on that they got a 3% interest rate during COVID. And so they want to buy a new property, but they're not sure yet. They're waiting for things to get better. But if you look at the big picture, the huge real estate boom from 10 years ago, like whatever that was, 2008, like mid-2000s, rates were higher than they were now. Rates are not bad relative to where they have been historically. They're just higher than they were during that amazing COVID boom. It is still so much, and you would agree, hopefully, so much smarter, even with rates where they are today, to buy as opposed to renting. If you take a look at a 7-year example of purchasing a property, even with rates in let's say 7%, versus waiting 2 years for rates to come down and throwing all of that money away every month on rent. The 7-year buyer is looking at about, on a $500,000 purchase from, like, the, let's call the home $500,000. Let's say they put 10% down, they spent $50,000. Their leverage return on that $50,000 over 7 years, while they're paying down their mortgage every month, while they're realizing the tax advantages of depreciating the property,
And
along
interest,
with writing
right?
off that mortgage
Yeah.
interest, along with realizing the appreciation of the property over the 7 years. All of those things. Maybe they move on and they rent the property out. They could be enjoying rental income as well on the property. All of those positives that far outweigh just throwing that $3,000 a month down the drain and getting nothing in return from
Yeah.
it. Whereas on that $500,000 property that you're only spending $50,000 to buy, in 7 years, you're looking at $500,000 to $600,000 in your pocket,
Yeah.
as opposed to 200 and some $1,000 you're spending on rent during that same time period, going to absolutely nothing. So, is it still time to buy? Yes, but the most important thing we tell everybody is what's going to happen. Supply is limited right now. Rates are higher than they have been. What's going to happen when rates go down? The buyer pool is going to go up, liquidity is going to go up, and that house that you've been looking at right now, it's $500,000, and you're not quite sure you can afford it because rates are a little higher than you want them to be. Well, when rates go down, you're looking, that same house is going to be closer to $600,000.
Yeah.
So if you wait 18 months for rates to get back into the mid fours, mid fives, to buy that same property, and you're paying an extra $50,000 to $100,000 for that property, as opposed to maybe a couple $100 extra a month in your mortgage payment for that time, it just doesn't make sense.
Yep.
Especially when you can just refinance that mortgage in 18 months.
Yep. And you're waiting for rates to go down along with everybody else. So when rates do come down, you're going to then compete with all those people that are joining the market, and you're still going to be dealt with a difficult competitive situation. Obviously, buying is not for everybody. There's certain people that aren't ready to buy or shouldn't buy. It takes a certain level of responsibility, and it's a big deal. A mortgage is essentially your house's collateral for a loan. That's a big deal, and not everybody should get into that. But if you have the means and you have that level of responsibility and discipline in your life, buying a home is a necessity to building multi-generational wealth. I mean, if you look at a lot of families, a lot of their money comes from real estate being passed on and passed on and passed on, and it's critical. If you look at the bottom 1% of homeowners, their average net worth is about $100,000. If you look at the same for renters, their average net worth is $1,200. Obviously, there's factors that go into that, but that's a pretty stark contrast. And so ownership, it's not the best investment strategy, but you're going to be paying for somewhere to live anyways. It might as well be an appreciating asset that you're building equity in.
Absolutely.
Yeah.
And it's the benefit of leverage when it comes to buying that asset, the benefit of the fact that you can't close on that asset without a bank appraiser telling you, wait a minute, you might be paying too much for this. You can get out of this contract because this might be too expensive of a property. There are so many safeguards that protect you when you buy that asset, but leverage is the biggest benefit in terms of, you can't buy, the S&P 500, has a historic rate of return of 8%. But if you wanted to buy $10,000 worth of stock, you've got to come up with $10,000. Whereas if you want to buy a $100,000 house, you might only have to spend $3,000 to buy that house with an FHA loan. And that house goes up 8%. You're looking at $8,000 on your $3,000 investment in the same time period, and you're looking at a return of almost 300% in a year, as opposed to 8% on your money with the S&P.
Yeah.
And with S&P, you're not realizing the benefits of writing off the depreciation on the property, writing off the mortgage interest on the property. You're not realizing the fact that, I can't rent out my stock portfolio, but I can rent out that property if I need to, and generate rental income from it.
Yeah, yeah.
With Airbnb has changed the game for a lot of folks who are worried about the carrying costs of an investment property. Does it make sense to get into this? And now you have other ways, VRBO, Airbnb, to carry that property in case you get stuck. Whereas you don't have those types of safeguards and safety net with stocks and with bonds and with other investment avenues.
Yep. And your house is a tangible asset. Land is a tangible asset. Contrary to popular belief, I saw this video the other day of somebody with a really nice McMansion on a trailer, and they said, bring in my house from Austin, Texas to Northern Virginia to get a good price. What they're failing to realize is it's not the house, it's not the sticks and bricks that carry the most value, it's the land. Obviously, the type of house on the land will increase that value, but your house at the end of the day depreciates. If you want to get top market value when you sell your house, chances are you're going to have to put some money into updating it unless it's already up to scuff. And so the land is what really holds the value. And if you're not owning land and you don't have a physical, tangible asset that if they want to take from you, they got to kick you off of it, then I really feel as though you're not properly diversified. That doesn't mean you should put all of your money in real estate. Nobody would recommend putting all of your money into anything. But owning land, I think, is critical to your portfolio. And if you're going to be living somewhere anyways, again, it might as well be your place.
Family to the Annapolis area 3+ years ago, and I know that every time I get back to Northern Virginia, it's just crazier and crazier. You've got
always
Amazon, who is in the process of, if they haven't already, brought 25,000 new jobs to the area. You've got all of the federal jobs. You've got the technology jobs, the finance jobs. It's just, how much of a supply issue are you seeing right now? Not just because of people not wanting to get rid of their 3% mortgage, but because of all of the incoming employment factors and all of the all the transits moving here for work from the West Coast and wherever else. Like, how tough is it right now to find a place and actually get a contract accepted?
I mean, it's a tough place. Anything that's good, if it's priced well and it's up to date, it'll sell in a weekend. We'll have multiple offers and it'll be really hard to get that property. Anything else is going to have a little quirk. Like, for example, there's this house in Vienna I know that I'm talking about on Moorish Avenue where the garage goes below grade on the side of the house. It drives down to the basement, and so that's where you have to park and walk upstairs to get to your main level. That house is going to sit. It's not something that would be a deal breaker for somebody when interest rates are, say, 3%, but when they're 8%, it's higher. Now, for the inventory issue, 30% of inventory right now is new builds, and most new builds are in the luxury space. You're talking million plus. So for the first-time buyer to get into this market, especially in this area, it's very difficult. Any property that's going to be cheap and in a good area is also a rentable property. And so you not only have to compete with other buyers that want that property for themselves, you're going to have to compete with investors. And a lot of the times, they can be cash investors. And as a seller, I'm advising my seller that the cash offer is a much stronger offer than one that's financed, frankly. So it's very competitive to find something. And so in order to find something, you need to know where to look, you need to know what to look for, and you need to be creative with how you win offers. It's not just the sales price that wins you an offer. There's plenty of other factors, including how you get your financing done.
Sure, and you mentioned jumbo loans.
Jumbo loans,
when we were talking the other day, and it is, the stigma behind or around jumbo loans, like, there shouldn't be one. Like, it just, all that means is there's a set amount that every county announces, where if your borrowing limit is above that threshold, and I think it's something like in Fairfax County, like $726,000 right now. Anything above that amount is regarded as a jumbo loan. As far as cash buyers right now, like with this this interest rate environment, why not hold on to that cash as opposed to using somebody else's money to make that transaction.
Yep.
And using that cash to, we have advised several clients to, if you're thinking about putting 20% down on a property, well, we can get you 10% down on the property, get you a good mortgage, and get you a second trust to avoid having to pay private mortgage insurance. If you think you can, keep your money, take that other 10% and put it into something that allows you some liquidity and flexibility in the meantime. Real estate is many things, almost all of which are good. One thing it is not is liquid. Real estate isn't something where if I wanted to get my money out of my house, I would not be able to just, go online and click a button. There's a process involved, whereas, you can go to your E-Trade account and liquidate your stock portfolio and have your money in your account tomorrow. But to make up for that lack of liquidity, keep money in your pocket. Use someone else's money, when applicable, and take that liquidity of yours and find other avenues to diversify yourself.
Yeah. And as we mentioned earlier, your interest is a tax deduction. So you're saving money over the year, and if you break that down on a monthly basis, it does impact how much you are, in theory, paying per month. And so there is a difference there. Well, yes, higher interest rates obviously are not ideal. I don't want to pay interest. It's like paying rent. It goes nowhere, goes to somebody else, not me, But while you are slowly building your equity in the early stages of ownership, you're able to write off all these taxes and hopefully your property is appreciating. Luckily, we have good historical data that real estate is on the upward trend. There may be little dips, but it always ends up going back up. Part of smart buying is determining whether you're in a dip or not. If I knew, I'd make my clients a lot of money. If I had a crystal ball and could predict the market, I'd be killing it. I'd be the number one realtor in the game. But I don't. And it's important to weigh all the other factors involved. It's important to also look at different strategies. Like financing, for example, is a big way where you can strategize. One of the biggest issues with buying is financing. And so let's say for your first time home, you're probably going to live there 5, 6, 7, 8 years. You're not going to live there for 30 years. Maybe you will. I don't know. You can look at different loan products to cater to that. You can look at an ARM, an adjustable rate mortgage. At some point, interest rates should come down. And so if you only plan on living there for a few years, you can get a lower rate with an adjustable rate, and then when it goes down, when the rates go down, your rate goes down. And if you want to stay there longer, you can just refinance at that lower rate. So there's plenty of strategies to buy now, because it's one thing to want to predict where the market's going to go, or interest rates going to go down and more buyers are going to come in and values are going to go up. That's one thing. It's another thing to look at what we have here and now. It's easier to make a decision based on the information you have in your hand than just information that people are thinking about and brainstorming that's just out in the universe, so to speak. It's the bird in the hand versus the bird in the bush. We know what the market is now. We know what the environment is now. We know what the interest rates are now. And so this is the time to make the most informed decision about buying or not. Now, if you make that decision and it doesn't make sense, it doesn't make sense. Nothing we're going to do about it. You shouldn't make a decision that's not in your best interest, no matter what people are telling you. If you don't think it's going to work, don't do it. But if you do want to buy, it's important to do your due diligence. If your answer is going to be no, you might as well have a reason for no. And you should look into it and have conversations with lenders. Have conversations with real estate professionals. Find out if buying for you now is right, or if you're looking to sell. You need to have conversations and stay informed. For a lot of people, this is the biggest asset you have in your life. You should have people advising you on that process. You should have people keeping you up to date on what's the value of this asset. Are they building a data center in your neighborhood and that's scaring people? Do they think their brains are going to get fried and so people are all going to start selling? That's going to impact your asset. And you need to have your finger on the pulse and understand what's going on with a lot of people's, generational wealth. And so it's really important to be talking to people as much as you can about your property.
And that's one of the things that separates us as a local lender as far as our process. We spend the time with our buyers, educating them, taking a look at their options. Does it make sense to put some money aside for liquid assets other than real estate so that you can hold on to them for a rainy day? Does it make sense to buy in certain areas? Does it make sense to get an adjustable rate mortgage based upon your buying time frame, your plan for how many years am I going to live in this property before our kids and I outgrow it, before we have to move for work or whatever else. But we, as opposed to some of these online mortgage retailers that just like, here's a rate, click on these buttons. Like, we take the time to advise our clients and to see the total picture. And the total picture is so important as far as understanding the type of loan product that is not only good right now, but the type of loan product that's going to pay off for you in the long run. And absolutely, there is no bigger asset, no more important purchase in your life than your home.
No, exactly. And I remember when we were talking the other day, you mentioned that you'll even advise your clients on, you might be able to put this amount into your house, and if you put this amount into the stock market, or you put this amount in that you don't necessarily, you're not a financial advisor, of course, but you do approach strategies that aren't just put as much money in the house as possible. You look at other ways for them to optimize their wealth. So you take a holistic approach to the whole process rather than, done, done. You really look at them and evaluate their situation and try to help them the most, which is critical.
Yeah, we don't know where rates are going to be in 12, 24, 36 months. So we don't have a crystal ball. I know that, the masses, like the Federal Reserve Board, there is overwhelming information that there is going to be an adjustment towards lower rates in the next 18 to 24 months, but we don't know. And one of the reasons why we advise our clients on maintaining some liquidity is, to take advantage when there might be like a sudden dip in rates, or when there might be an increase in rates, having the liquidity to buy down your mortgage so that you can lower your payment. Provide that flexibility. And flexibility is a huge part of the buying process.
Oh yeah, no, 100%. It's a fluid process. It can change at any moment. A deal can fall apart over the silliest of things, over the smallest of things. For example, I want the curtains to stay. No, the curtains are coming with me. Curtains. You can buy new curtains at a store. Boom, completely done. So it's fluid, dynamic, it's quick. It's also a very highly emotional decision. When people are looking to buy or sell, it's usually, there is the finances, of course, but a lot of it is usually emotional. I've met people that live in Vienna, for example. They have one of the older Ramblers. All the other houses in their neighborhood have been torn down, and they're ready to sell their house, and they know exactly what the next buyer is going to do. They're going to bulldoze their house, flatten their yard, all the memories there, all gone. And that's a tough conversation to have with somebody. It's very emotional. They could make good money by selling their lot. That's the reality. They probably bought their house for under $100,000, and they're about to sell it for close to $1 million, right? That's a lot of money. Why should they care? Because it's very emotional. A home is where you raise your family. A home is where you feel safe. A home is after a long day of work, you go home. That's important to people. And it's a very emotionally driven process. And so having somebody that respects your emotions and understands them, because you don't want somebody to blow it off and go, forget about it. Who cares if you buried the dog in the backyard? This person's going to pay $980 in cash, right? You can't do that. But at the same time, you need to take their emotions into account and then bring in a little bit of logic. Kind of explain to them, it's your choice, but this is where we're at. And I think that's critical to making the best decision, because you cannot rule your life entirely on emotions. I've certainly done that in my life before, and it's never worked.
You and me both. Right?
Yeah, no, exactly. You need logic. You need the facts. You need somebody who knows what's happening. You need somebody who's seen it before, and that's just the reality. Experience is critical.